Welcome to Smart Finance Talks. It's amazing how quickly the mood can shift, isn't it?
Oh, absolutely.
You see a particular area of the economy buzzing, everyone's optimistic, and then suddenly things can just deflate. That rapid change in collective outlook, that's really what we're unpacking today.
Exactly. We're taking a deep dive into the intriguing relationship between economic confidence and financial stability, and those moments when that confidence falters.
Right, sometimes leading to pretty significant downturns.
Yeah, and we'll also be exploring how our shared expectations can actually shape the economic landscape, this concept called self-fulfilling prophecy.
And our guide for this exploration is Roger Farmer's book, How the Economy Works: Confidence, Crashes, and Self-Fulfilling Prophecies.
It's a great source.
This edition is packed with valuable insights, and for you, who wants to grasp these concepts thoroughly and efficiently, it's a fantastic resource.
Definitely.
We'll be looking at real-world examples like the dramatic collapse of Northern Rock, the lasting impact of the Great Depression, and the complexities of the 2008 financial crisis.
And through these historical events, we'll also be examining some foundational economic debates, sort of contrasting the long-held ideas of classical economics with Keynes's work.
Right, and how thinking evolved after that.
Yeah, and tracing how economic thinking has evolved since then.
Our goal today is to really get under the hood of what drives economic booms and busts. We want to understand how something as seemingly intangible as confidence can lead to massive financial shifts.
Yeah.
And how what we collectively believe can actually become our economic reality. Okay, so let's dive in with a really clear example: the story of Northern Rock.
Right. Chapter 1 of Farmer's book starts with this 2007 event, and it's a powerful illustration of a classic bank run.
The bank run, yeah.
What's fascinating is that it wasn't necessarily due to the bank being fundamentally insolvent at the outset.
That's the crucial bit, isn't it?
It is. The crucial insight here is that confidence in financial institutions isn't solely based on fundamental solvency, but is, a fragile, self-sustaining belief.
That's right. Northern Rock's business model relied heavily on borrowing in the short-term London Interbank Offered Rate, or LIBOR, market.
The LIBOR market. Yeah.
Now, LIBOR is essentially the rate at which banks lend to each other for short periods. When those rates suddenly increased in 2007, it became more expensive for Northern Rock to operate, putting them in a vulnerable position. Why was that such a big deal?
Well, because their reliance on this short-term funding meant they were highly susceptible to any hesitation in the market's willingness to lend.
Okay.
But the real crisis began when depositors started to lose faith in the bank's ability to repay them.
Exactly. Even though the bank initially had more assets than debts, the sheer panic of people wanting to withdraw their money all at once created a crisis.
It became a self-fulfilling prophecy of collapse,
Right.
driven by fear rather than a fundamental lack of funds in the beginning.
It really shows how fragile confidence in the financial system can be.
It does. And to understand why this confidence is so critical, it's helpful to look at some underlying economic principles. The book explores the contrast between classical and Keynesian economics.
Okay, so classical economics.
Yeah,
What are the
okay.
key ideas we need to understand there?
Well, at its core, classical economics, with thinkers like Leon Walras, emphasizes the idea of general equilibrium.
General equilibrium, like everything balancing out.
Kind of. Think of it like all the interconnected parts of a complex machine working in harmony. The belief is that supply and demand in various markets will naturally balance out through price adjustments. They also champion the quantity theory of money, which suggests a direct link between the amount of money in circulation and the overall price level.
So a very hands-off approach, believing markets will sort themselves out.
Largely, yes. The prevailing idea was that if left alone, markets would efficiently allocate resources.
Then came the Great Depression.
Exactly. The Great Depression posed a significant challenge to these beliefs. This is where Keynes comes in. Classical economics assumes an inherent market self-correction, while Keynes highlights the need for active intervention due to persistent market failures.
Right, Keynes, the opposing view. What was his main disagreement with classical thinking?
Keynes, whose ideas became prominent during the, economic devastation of the 1930s, argued that markets don't always self-correct quickly,
Okay.
and sometimes not at all. He believed that government intervention, especially by managing aggregate demand,
Aggregate demand, the total demand in the economy.
the total demand for goods and services could be necessary to stabilize things and help an economy recover from a downturn.
And why wouldn't it self-correct?
Well, he pointed to things like sticky wages and prices, what Chapter 2 calls economic friction, as reasons why unemployment could persist even when there were jobs available.
So wages don't just drop easily to meet demand.
Not always, or not quickly enough.
Right.
So instead of this automatic rebalancing, Keynes saw the possibility of long periods of low demand and high unemployment that wouldn't necessarily fix themselves. Precisely. And his ideas had a profound impact. As the book highlights, the experience of the Great Depression led to a major shift in economic thinking towards Keynesianism.
Yeah.
In the U.S., for instance, the passage of the Employment Act of 1946 reflected this new emphasis on the government's role in maintaining full employment and production.
It's striking to think about that shift, because the 1920s, as the book describes, were a time of huge economic optimism.
Oh, absolutely. A real faith in the power of free markets.
Widespread belief in the market's ability to create prosperity.
Yeah, speculation was widespread, particularly in the stock market, and prices were rapidly increasing.
And this optimism even extended to some well-known economists. The book mentions Irving Fisher.
It does.
It's fascinating that even experts can be caught up in market sentiment. Were there any particularly notable examples mentioned?
Yes, Irving Fisher is a particularly memorable example, highly respected economist, who, despite famously stating just before the crash that stock prices had reached a permanently high plateau, subsequently lost a large portion of his wealth in the 1929 stock market crash.
Ouch. Permanently high plateau. Famous last words.
Indeed. So, this booming optimism came crashing down, quite literally, leading to the Great Depression.
What were the immediate effects?
Well, the stock market crash triggered a sharp and prolonged decline in industrial production and a dramatic surge in unemployment. It marked the beginning of a long period of economic hardship.
And the response?
Initially, there was significant debate among economists and policymakers about how to respond. Many, still adhering to classical ideas, were hesitant about large-scale government intervention.
So Keynesianism really gained traction as a way to understand and potentially address these severe economic downturns.
It did.
It introduced this idea of managing overall demand in the economy.
That's right. The central idea is that if there isn't enough overall demand for goods and services, businesses will cut back production, lay off workers.
Leading to recession.
Exactly. Keynesian economics provided a framework for understanding how government spending or tax cuts could stimulate demand and help get an economy back on track.
And then we have the Phillips curve, which the book discusses in Chapter 4 through the work of Bill Phillips.
Ah, yes, Bill Phillips.
This suggested a fairly direct trade-off, correct?
Yes, Phillips's work suggested an inverse relationship between inflation and unemployment.
So lower unemployment might mean higher inflation.
That was the idea, yeah, and vice versa. This concept became a key tool for Keynesian policymakers who believed they could sort of fine-tune the economy, managing these two crucial economic factors.
Nice trade-off.
It seemed neat, but the Phillips curve's simple trade-off between inflation and unemployment broke down in the 1970s, revealing the complexity of macroeconomic management.
Right, because as the book points out, this dominance of Keynesian thinking faced some significant challenges then. What happened that caused a rethink?
Stagflation. That was the big one in the 1970s.
Stagflation. Stagnant growth plus inflation.
Exactly. A particularly difficult combination of high inflation and high unemployment happening at the same time.
Which the Phillips curve didn't predict.
No, this was something the traditional Phillips curve, with its neat trade-off, couldn't easily explain. This unexpected phenomenon led some economists, like Barrow and Taylor, mentioned in Chapter 4, to question the fundamental assumptions of Keynesian economics.
And this questioning opened the door for new ideas.
It did.
Including the rational expectations revolution, pioneered by Robert Lucas, as we see in Chapter 5. What's the core concept there?
Rational expectations suggest that individuals don't just form expectations about the future based on past experiences.
Okay.
But rather they use all available information and act in a way that reflects their best predictions about what's to come.
So people are seen as being much more forward-thinking and sophisticated in their economic decision-making.
That's the theoretical starting point, yes.
But doesn't that assume a level of economic knowledge that most people simply don't have in reality? How do we reconcile that with observed behavior?
That's a crucial question and a fair critique. While the assumption of fully rational expectations is a simplification,
Okay.
The theory highlights the importance of expectations in influencing economic outcomes. It stresses that people do anticipate.
How so?
Well, if people anticipate that government policies will lead to higher inflation, for example, they might adjust their behavior demanding higher wages, perhaps,
Right.
which could indeed undermine the intended effects of those policies. Expectations matter.
Got it. The book also touches on the real business cycle theory around this time, also linked to Lucas and Prescott. How did that differ?
The real business cycle theory, or RBC, offered an alternative explanation for economic fluctuations.
Okay.
It suggested that these ups and downs were primarily driven by real shocks to the economy, things like technological changes or shifts in productivity.
Not just demand.
Right, rather than just changes in aggregate demand, which was the main focus of Keynesian thought.
So shift away from the idea that managing demand was the primary tool for stabilization.
In significant ways, yes. This period was a real period of intellectual ferment, with new ideas challenging the established Keynesian framework.
Interesting.
And this leads us to Chapter 6 and the role of central banks. We often hear about the U.S. Federal Reserve or the Fed. What exactly is their role in all of this?
Well, as the book explains, central banks like the Fed are crucial in managing the money supply and influencing interest rates.
Key players.
Absolutely. They play a vital role in trying to keep inflation in check and promote full employment, a delicate balancing act, as we've discussed.
The Fed's history, as the book briefly outlines, shows its evolution trying to manage these sometimes competing goals. The period known as the Great Moderation saw a period of relative economic stability, and central banks were often credited for this.
But things didn't stay moderate forever.
No. The book also introduces the concept of the Minsky moment.
Hyman Minsky.
Yeah. What's fascinating here is the idea that long periods of stability can paradoxically lead to increased risk-taking.
Yes. The idea that things can get a little too comfortable,
Exactly.
leading to a buildup of financial vulnerabilities.
Yeah.
And then a sudden loss of confidence can trigger a crisis.
Precisely. Excessive borrowing, asset speculation can occur during stable times.
Because everyone feels safe.
Right. And when confidence falters, maybe triggered by some small event, it can lead to a rapid unwinding and a sharp economic downturn. The 2008 financial crisis is a stark example of this dynamic.
It really brings us back to that central theme of confidence, doesn't it?
Absolutely.
And speaking of downturns, Chapter 7 delves into a really persistent problem. Why does high unemployment sometimes stick around for so long?
Yeah, that's a tough one.
It's not always as simple as a lack of available jobs, is it?
No, it's not. The book introduces the concept of search frictions in the labor market.
Search fictions, like
Yeah.
it takes time to find the right fit.
Exactly. Think of it as the time, effort, and resources it takes for job seekers and employers to find a good match.
So even if there are open positions and people looking for work, the process of connecting them isn't instantaneous or frictionless.
Precisely. These frictions can lead to a situation where unemployment remains stubbornly high, even when the overall economy might be showing signs of improvement.
And wages play a role too.
Yeah, the book also touches on the idea that wages might not always fall quickly during periods of high unemployment due to various factors, contracts, minimum wages, morale considerations.
So they stay sticky.
They can be sticky, further complicating the picture.
And this persistence of unemployment, the book suggests, can also be linked back to self-fulfilling prophecies. How does that work in this context?
Well, think about it. If businesses and consumers lack confidence in the economic outlook,
They hold back.
right, they may be hesitant to invest, hire new workers, spend money. This lack of activity then contributes to continued low economic growth and, unfortunately, sustained high unemployment.
So the expectation of a weak economy actually helps create it.
It can, yes. It's a bit of a vicious cycle, isn't it?
It really is. Now, shifting gears slightly, Chapter 8 asks a seemingly straightforward question. Why should we even care about the stock market?
Right.
For many, it feels quite removed from their daily lives.
The book argues that the stock market is far from detached. It serves as a key indicator of the collective confidence,
Or lack of confidence.
or lack thereof, yes, that investors have in the future health of the economy and individual companies.
So, rising stock prices might signal optimism and expectations of growth, while falling prices could indicate pessimism and fears of a downturn.
That's a good way to put it. The book contrasts the classical view, which tends to see stock prices as reflecting the intrinsic value of a company.
The fundamentals.
Right, the fundamentals. Contrasting that with a more Keynesian or behavioral perspective.
Okay, what's that view?
This latter view emphasizes the significant role that investor sentiment, often referred to as animal spirits.
Keynes' term.
Exactly. Those psychological and emotional factors that drive investors' decisions, it argues these, can play a huge role in driving market fluctuations.
So prices don't always seem entirely rational.
Sometimes they don't seem to, yeah. George Soros's observation about reflexivity is mentioned in this context, how expectations shape outcomes, which then shape expectations again.
Right, this idea that market psychology can take on a life of its own.
It can feel that way.
And the book highlights how these shifts in market confidence can have broader economic consequences, using the 2008 crisis as a prime example.
Absolutely. The collapse of confidence in asset markets, including the stock market, during the 2008 financial crisis, had a cascading effect,
Spilled over everywhere.
triggering a much wider economic downturn. So, understanding market sentiment, even if it seems detached at times, can provide valuable insights into the overall direction and potential vulnerabilities of the economy.
So to bring it all together, it seems like this deep dive into Roger Farmer's work really underscores that the economy isn't just a machine driven by numbers.
Not at all.
It's deeply influenced by this often unseen force of confidence.
Absolutely. From the dramatic bank run at Northern Rock to the devastating impact of stock market crashes and the persistent challenge of high unemployment. Our beliefs and expectations about the future can indeed become self-fulfilling prophecies, shaping our economic reality in profound ways.
And for you, who's always keen to understand the bigger picture, hopefully this is giving you some surprising insights into those underlying drivers of economic booms and busts.
Yeah, hopefully.
Giving you a bit more clarity in navigating our complex financial world.
And maybe consider this. If our expectations can have such a powerful influence on the economy, it raises an important question.
Which is?
What role do we each play in fostering a climate of informed confidence? And how can we learn to distinguish between healthy optimism and the kind of, unchecked enthusiasm that might just lead us to another downturn?
Distinguishing rational optimism from irrational exuberance.
Exactly. It's definitely something to think about as you continue to observe the ever-evolving economic landscape.